Welcome to MyFarm's Dairy Investment Outlook. This presentation is MyFarm's view of the outlook for dairy over the next 2 to 5 years. We are positive about this outlook, but we have made the case from an independent commentary, and we have referenced this material at the back of the presentation. The current season started with a low milk price, currently $5.25 per kilogram of milk solids, and this compares to the 5-year average of $6.50. However, since the initial price was set, global dairy prices have risen by more than 29% from that point, reflecting a drought in the US and generally low milk prices and high feed costs, which have had a significant effect on milk output, particularly in the Northern Hemisphere. This low supply outlook plus high demand growth that we are still experiencing has resulted in rising commodity prices over the last 4 months, and we expect will result in a rising milk price during this current season. The long-term demand outlook for dairy is very strong, particularly coming from developing economies driven by rising incomes and changing diets associated, and also due to population growth. In the 5 years to 2010, the developing world accounted for almost 3/4 of global growth, whereas before 2000, 2/3 of growth came from the developed world. The world is now witnessing a surge in demand for basic materials, including food, to feed growing global middle classes. Rising incomes results in people firstly increasing what they eat, and then changing their diets away from carbohydrate-based to protein-based foods. So we can expect in the next 20 to 30 years increased consumption of meat and dairy, and also increased land use for those products, which will require more water and more land use. Of course, population growth will also increase demand, with 35% more people forecast by 2050, particularly living in sub-Saharan Africa and Asia. So this demand outlook from ANZ's recent report, Greener Pastures, shows one possible outcome with 2.6% annual demand growth through to 2030. This may not seem that impressive, but it's significantly ahead of the demand growth that we've seen in the past 20-30 years, and is well ahead of supply growth potential, as I'll show shortly. Food supply is constrained, and that constraint is expected to keep prices high. Growing constraints on water and land, there's reduced productivity growth, and the net effect is the OECD expects increasing commodity prices. We're running out of land. Currently, agriculture uses 37% of the world's land mass, and there's been 0.2% growth in that use of land and 0.5% for arable uses. 31% of the remaining land is in forest that is unable or unlikely to be developed. 27% is in areas that are deserts or soils with poor properties for agriculture, and we know there's increased demand for urban land use. So United Nations FAO estimates only 70 million hectares will be developed to agriculture by 2050, with 0.1% into arable land, which is a big slowdown on the 0.5% growth that we've seen in the past 40 years. We're also running out of water. Agriculture currently uses 70% of all water use, and in countries where urbanisation and industrialisation is occurring, there's real pressure on that water use and a decline in water use for agriculture. Increasing number of countries and parts of countries are reaching very critical levels of water scarcity, and 15 to 35% of water used for agriculture may in fact be unsustainable. This chart shows the productivity growth needed to keep up with the various demand outlook forecasts. The top line is the ANZ growth line needed to keep pace with the highest growth demand projections. And we can see here that it's only in the 60s and 70s where productivity growth met this sort of demand outlook, and that today we're falling behind even the most pessimistic of growth forecasts. So agricultural yield productivity growth is unlikely to help meet growing demand. So we think the outcome of all of this is stronger prices for New Zealand products. But just how will we fare with this demand outlook? The big advantage of New Zealand dairy farming is our pasture-based farming systems, where cows graze for their feed directly in paddocks. It costs about 15 cents per kilogram of dry matter, a unit of feed for cows, in New Zealand. This compares to the costs for US confinement systems at about 36 cents a kilogram of dry matter. So although we receive a lower milk price than farmers in the US typically receive, the margin that we earn of milk to feed is typically 3 times. Whereas in the US, because of their higher feed costs, the milk price is only 1.68 times their feed cost. This is all another way of saying Dairy New Zealand is much more profitable and very able to withstand fluctuations of commodity prices and still remain very profitable. So milk price and return forecasts are for rising commodity prices and rising milk prices. Just what happens in the current season won't be known until 2013, but already we have higher forecasts from Westpac and AgriFax for the current season. The outlook for 13-14 and 14-15 is much stronger as the effects of reduced supply from the Northern Hemisphere and growing demand take hold. So 2 forecasts from AgriFax and Westpac, 625 and 640 for 13-14, and for 14-15, 710 and 670. We have to take these forecasts with a pinch of salt. There is a lot that can happen between now and then, but at these sorts of prices we can earn 6 to 7% cash return from a good dairy farm, which we believe is very competitive in the market compared to other investment options. The very big picture has come from the Australian Bureau of Agricultural Research and Extension. So a conservative guide is that our agricultural industry can at least double, and more than double, its current output in today's values. So there's $57 billion potential for New Zealand by 2050 compared to mid-$20 billion of export revenue today. And there's $550 billion of extra value over the next 40 years. So this long-term outlook will be reflected, we believe, in milk prices, investment returns, and the value of farmland ultimately. Many people have talked to us about the merits of investing in a farm versus investing in Fonterra. For us, an investment in a farm is an investment in rising commodity prices and rising productivity on farm. We feel rising commodity prices will be reflected in dividend returns and that underlying value of your land. In contrast, an investment in Fonterra is based on the profitability of Fonterra's value-added business. And in fact, that business is adversely affected by rising commodity prices because the value of the raw milk that they collect and process is actually a cost of goods sold for that value-added business. So if you're positive in this outlook, why not invest in a farm which will also have a small portion of investment, around 15%, in Fonterra shares? What could go wrong? We know there's an uncertain outlook in Europe and in the US, which is likely to take some time to resolve. A significant deterioration in that outlook could have an influence on this picture. Of course, a slowdown in development country growth could also influence the rate of demand growth from growing middle classes. It's encouraging, however, to see consumption-led growth starting to appear in China. We could be surprised with agricultural productivity growth. We expect regulations in New Zealand to tighten around the environment, and we're very proactive in that area. But there could be some implications for productivity and profitability of farms beyond what we expect. We do expect a strong Kiwi dollar, and a catastrophic event like foot and mouth would obviously have a devastating effect on dairy farms and dairy farm investments. So whilst we expect a strong commodity price outlook, we also do expect fluctuations from year to year. And that's why we've always focused at MyFarm on buying good quality farms, and keeping debt to a minimum. Readers and listeners to this presentation are welcome to look at some of these references. A Google search on Outlook for Dairy, FAPRI, FAO, OECD, Food Demand, Dairy Outlook will all show independent analysis presented here in this presentation. Thanks very much for your time.